Every day, countless amateur day traders liquidate their entire accounts before the market has even been open for 30 minutes. The opening bell rings, price spikes violently in one direction, and a surge of adrenaline pushes them to execute reactive market orders without a plan. When the inevitable whipsaw occurs and clears out their capital, these retail operators blame the market. They assume the opening volatility is simply too wild to navigate safely. Professional operators view the opening bell differently. The immediate surge in volume and price action is an expected mechanical event, not a failure point. This chart shows the true cause of a blown account. It happens before a trade is even placed. The failure lies in a complete lack of structural risk architecture. Eradicating this flaw requires a strict proactive system. In professional environments, we utilize the DRW Wave Engine. This engine operates on 3 mathematical pillars. It quantifies stored pre-market energy, it adjusts automatically to live intraday volatility, and it enforces strict execution probabilities. Surviving the live market is impossible if you are reacting emotionally to moving candles. You must build mathematical boundaries before the session ever begins. To construct these boundaries, we have to examine the market hours before the opening bell. Amateur operators look at the pre-market regime and see small overlapping candles. They dismiss this low-volume period as meaningless noise. A professional treats this exact same period as the primary charging station for the entire upcoming day. Here we see a 5-minute pre-market futures chart. When price is trapped inside a narrow corridor, the DRW engine identifies a squeeze state. This structure indicates institutional algorithms are actively balancing inventory. In physical terms, this restriction creates stored potential energy. When regular trading hours begin, heavy cash volume floods the tape. The restriction is lifted, and that potential energy instantly converts into kinetic energy. This creates our first axiom. The tighter and longer the pre-market squeeze, the more explosive the resulting structural expansion will be at the open. Identifying this state of compression is a mandatory prerequisite. You cannot calculate risk without first measuring the stored energy. Treating the pre-market as a coiled spring allows an operator to mathematically anticipate the velocity of the upcoming session. It removes the element of surprise from the opening bell. Once that spring is released and the regular cash session opens, your relationship with risk must adapt instantly. A standard retail trader finds a setup and guesses where to place their stop loss based on an arbitrary dollar amount. For example, deciding they will lose exactly $200. Completely ignoring the physical breathing room required to survive the active institutional wicks of the session. The DRW Wave Engine solves this through a continuous dynamic calculation. The exact moment the session begins, the system samples the true structural range of the newly opened market. The engine takes that live distance, multiplies it by a constant 40%, and outputs a fixed, non-negotiable risk unit dictated entirely by real-time volatility. This dynamic risk unit determines your position sizing through strict inverse correlation. As the structural range widens, your contract payload must shrink. On a high volatility day with massive expanding candles, the wider risk unit demands you scale down your lot size. Your net dollar risk remains exactly the same, but your stop loss is placed wide enough to survive deep pullbacks. Conversely, if the morning volatility is low and the range is compressed, your risk unit shrinks. The tight boundary permits you to safely scale up your payload. In both scenarios, the total capital exposed is identical. Weaponizing live volatility to dictate contract sizing replaces arbitrary fear with structural certainty. It ensures your stops are placed securely outside the bounds of random market noise. Protecting capital is only half the architecture. If you possess a broken mathematical payout ratio, you will eventually bleed your account to zero. Retail traders take microscopic profits the second a trade goes green to protect a winner, but allow bad positions to run deep into the red. Risking 4 units of capital to make 1 unit of profit guarantees ruin over a large enough sample size. To prevent this, the DRW engine enforces a strict execution matrix. This grid visualizes a long entry marked in blue, with the calculated risk unit projecting downward as a red block. The system automatically projects the required institutional profit target upward, a minimum 1-to-3 ratio. The raw survival mathematics of operating exclusively under this ratio become obvious when mapped to a large data set. This chart outlines a worst-case scenario, failing 60% of the time, mapping 6 lost risk units out of 10 trades. The remaining 40% win rate translates to 4 winning trades mapped to our required 1 to 3 minimum. Even with a severe failure rate, those 4 winning trades generate 12 units of profit, offsetting the 6 losses and leaving 6 risk units of positive equity. Enforcing an asymmetric payout matrix transitions the operator from an emotional speculator into a systemic risk manager. Being right on market direction is entirely secondary to executing geometric probability. The DRW Wave Engine demands a strict operational standard. Price movement is not random casino noise. It is highly structured, measurable energy. The protocol follows an absolute sequence. First, measure the stored potential energy building inside the pre-market compression zone. Second, sample the true structural range of the opening session to dynamically calculate the volatility-adjusted risk unit. Third, refuse to put capital at risk unless the structural geometry guarantees a minimum 1 to 3 institutional payout. These parameters must be flawlessly integrated and mathematically validated before you ever touch the execution button. True professional longevity is engineered entirely upfront. Hard-coat your risk to absorb intraday volatility, protect the system's structural bedrock, and let the mathematics dictate the outcome.